comes the turn of a regulator who had turned into a career academician, Dr. Kevin James, with insights gained from his tenure as a regulator, as well as a hardcore researcher, actually. So Dr. James is a co-investigator in the Systemic Risk Center at the London School of Economics, and his research interests are in the areas of the relationship between financial market effectiveness, regulation and economic performance, economic and regulatory aspects of systemic risk, corporate finance, the economics of fund management from broader level to the micro level. So he has all those research areas, which I think he must be carrying it from his regulatory experience with various regulatory authorities. So his research on these topics have been published in leading finance and economic journals, and he has previously worked with, as I told you, as a regulator with the Financial Conduct Authority, the Center for Central Banking Studies at the Bank of England, the FSA, and the SEC. He has a PhD in economics from UCLA and a BA from Smartport College. So here is Dr. Kevin with his interesting treatise, Connecting Dynamism in the Regulation of Financial Markets to the Growth of Total Factor Productivity in the Economy. So maybe looking at the topic that was given to me, so I thought maybe I'll take the liberty of explaining a little bit about total factor productivity, which is basically an economic concept. It is actually the productivity of all inputs taken together. And TFP is a measure of the output of an industry or economy relative to the size of all of its primary factor inputs, which is capital and labor. A healthy and sustainable economic growth can only be achieved through a sustained TFP growth. That means there is no growth in labor or capital that is leading to, but the technological innovation and the efficiency that is achieved by way of increased technology levels, increased skills of the labor, and efficient management of the capital that is available. So that's more important for healthy and sustainable TFP growth. So let's hear about what the new drug that Dr. Kevin proposes to treat the TFP malaise that is haunting most of the economies today. Without much ado, let me hand over the mic to Dr. Kevin.
Thank you. So basically the big picture idea is that without having sustained economic growth, we're going to have sort of economic, political, and social catastrophe, basically. And so the question is, what can financial regulation do about that? Normally, we think of financial regulation as being very focused on individual customers and that sort of thing. But what I'm going to try to convince you of today is that financial regulation also has a bigger, much more macro role in promoting an efficient financial system. And an efficient financial system is kind of the foundation for a prosperous economy. So I think so my big picture takeaway idea is that regulators have to think more about how the financial system interacts with the real economy and how we can provide the financial system the real economy needs, as well as kind of the more micro kind of consumer protection type issues we tend to focus on. This is based on a paper I'm working on with Dimitri Chmokos at Oxford and my colleague Akshay Chotak at the Systemic Risk Center. And if you are inspired by these ideas, then you'll send me an email. We'll send you the paper. Okay. So basically, if you look at the evolution of TFP growth in the United States, what you see is that it was sort of low in the pre-war period, had this fantastic boom between 1950s and 1960s, and now it has plummeted back down to its pre-war levels. At that level, we're really facing kind of extremely dire situation going forward. If TFP growth remains as low as it is, then the United States economy is going to be suffering for a long time. Okay, so this is a really severe problem. This productivity growth problem has also affected other countries. So why do you have this pattern, this up and down pattern? So our theory is that it's due to financial markets, basically. When financial markets work poorly, like they did in the pre-war period here, then you have a sort of low productivity growth. The financial market reforms in the 1930s and 1940s sort of massively boosted market effectiveness, and that led to the sustained period of high productivity growth here. Over time, the regulatory system has not kept up with the way the markets actually work. So even though all the rules we have are still in place and people still follow their 10K forms or whatever it is for the SEC, the rules don't have the same effect, right? And so market effectiveness has, in practical terms, gone down, and that has been followed by a decline in TFP growth. Okay? And so the loss of financial market, so the loss of efficacy in the financial market reforms has had these very serious consequences for U.S. economic performance. Okay, so now, so basically, you think about financial regulation as a drug. So during the 1930s, we had these financial market reforms. We also had the invention of penicillin. And so you look at penicillin, it was fantastic, at the time. This is actually ciprofloxacin. And so the drugs work for a while, and then whatever it is that you're trying to wipe out with the drugs, sort of develop resistance or find some way around the drug, or there's a new strain or something, right? And then the drug starts losing its effectiveness. Okay? And so as regulators, we look at the system, we say, are people still taking the penicillin? So you give people the penicillin, are they taking the drug? Okay. But we don't spend anywhere near enough attention or pay enough attention to the fact that, is the drug actually working? Does it actually have the same effect it used to have? And so my story for the SEC is, we had this drug back here, and it actually worked well, and we're still giving people the same drug, but it's not actually working anymore, right? And so we need to think about what it is we actually want to have the financial system do. And the regulators have to think more about, are the reforms, or is the system actually working? Are we actually getting the efficient and effective financial system we need to sort of sustain the economy? I'm thinking that the answer now is no. And so we need to take a step back and think about, how can we design a regulatory system that works well for the economy that we actually now have? Okay. So that's the big picture. Now, I'll now go through a little bit of the detail and then talk about some of the regulatory implications. If you think the standard view of total factor productivity growth comes from endogenous growth theory, the work of David of Romer and all those guys, and the unifying thread of this enormous body of research is that economic growth arises from people creating ideas, right? So we have various factors that go into creating ideas. So like R&D is the most famous one. There may be scientific, like STEM labor, people like scientists and engineers. There are various other things that also affect it. That creates some idea supply, and then idea supply leads to productivity growth, right? That's this. So if you look at sort of textbooks on growth theory, it's almost all about, overwhelmingly about idea supply and the factors that affect idea supply. But that creates a puzzle, because if you look at what's happening to TFP growth in the United States and what's happening to the inputs that go into idea supply, they're going in the opposite directions. And so R&D spending as a percentage of GDP has been going up over time like this, but productivity growth has been going down like that. Okay? The puzzle is, if R&D creates ideas and ideas drive growth, then how can it possibly be the case that R&D is going up and productivity growth is going down? Like, what's going on with that theory? Okay? And so within the context of the theory, there's only one possible answer to that. Since ideas drive TFP growth, if TFP growth is going down, it must be because we don't have the same idea supply. So idea supply is going down for some reason. And if we're looking really hard for ideas, but the number of ideas is going down, then it must be that we're running out of ideas, right? So we're spending all this time looking for ideas, but we're not finding them. So there aren't ideas to find. And that, in a nutshell, is the very famous Robert Gordon conjecture. So Robert Gordon has, many of you are probably familiar with this idea, that basically economic growth is over because we're running out of ideas. Okay? And that's kind of it's a crazy theory if you think about it, take a step back and think like, how could we be running out of ideas? We have quantum computing, and Elon Musk is launching rockets into space. There's all kinds of stuff happening in the economy. It's the miracles of biotechnology. How can we possibly be running out of ideas? It doesn't make any sense at all. But within the context of the theory, within the context of growth theory, that's the only possible explanation, right? So the theory is idea supply creates TFP growth. Okay? So if this is going down, this has to be going down too. There's no other way around it. Okay? So the Gordon conjecture just follows logically or inevitably from the structure of how we think about growth, right? And so even though it sounds crazy, that's the only acceptable theoretical answer in some sense. Okay, to me, this is obviously a big picture view. Okay? But that's basically what's going on with growth theory and the debate on growth theory. Okay? And so our version is that that theory does not make any sense, right? That can't be what's going on. Okay, so Dimitri and Akshay and I have a different theory, which is this: that there are actually two things you need to create an innovation. You need to have idea supply, like some inventor has to come up with an idea, but you also need a firm to process that idea, turn it into an innovation. So it's not just an idea that goes direct. So you don't have ideas directly to TFP growth. You have ideas that go to firms. Then firms have to process those ideas to create an innovation. And it's the innovations that drive TFP growth. Okay? And so we have all the same factors that affect idea supply, R&D, that sort of thing, right? But market effectiveness influences how well firms process ideas. And financial regulation affects how effective markets are. Okay? And we think that idea processing is actually the binding constraint now on innovation, right? Okay, and so when you're thinking about why is TFP growth falling in the United States and in many other parts of the world, right? It's not because there are no ideas. It's not because this part of the problem here. It's because of this part of the problem here, right? That markets are less effective now than they were because, like, the regime hasn't kept up with the way the markets actually work, right? And that's because financial regulation hasn't been regulating the markets effectively. Right? And so the problem is here and not here, right? And so if you're thinking about how can we fix the TFP growth problem, instead of spending a lot more money on R&D, which I'll show you why that's a crazily expensive thing to do, we should spend like a little tiny bit of money fixing, making sure regulators do a better job of regulating the economy. Okay, so in a very shorthand way, intuitive way, let me give you the intuition for our analysis. So what we think about as this market effectiveness to idea processing channel is the following. So you have a firm that has a project, and to be successful, the firm has to attract some sort of outside investment by an outside party, like maybe financing, maybe skilled labor, maybe a supplier has to decide that they want to work with you to sort of improve your product, something like that. That's me. And so the probability that outside party makes that investment depends upon the market's estimate of the project's success. So firms then can pursue two basic strategies to develop their projects. They can take a short horizon, quick win strategy that focuses on signaling to maximize the probability of success without creating innovation. Right? So you do sort of very simple or very incremental projects to signal to the market that you have a successful project. Then they say, oh, you're going to be a successful firm, so we'll make this investment in you. Or you can take a longer horizon strategy that focuses on maximizing the value of the project given success by taking an idea and processing it. But since it's a longer horizon thing, you have less intermediate signals, right? So it's harder for the outside participants to know if you're actually doing something sensible, because you don't have like a short-term, payoff right away, right? And so that's sort of the trade-off we have. And so when markets work well, you don't have to spend as much time signaling, and so you can spend more time on innovation. So basically, when markets work well, firms spend more time processing ideas, which produce innovations that drive TFP growth. That's in a nutshell, that's the intuition of the theory. Okay. Now, financial regulation then affects market effectiveness because financial regulation governs kind of the information production that happens in markets. So effective regulation can increase the market's ability to produce information by requiring better accounting rules, better disclosure, less market manipulation, less insider trading, all those sort of things that are the core of financial regulation. Can really massively improve the economy's ability to produce the information, the market's ability to produce the information that enables firms to shape their strategies. So in going back to the history, then the massive reform effort of the 1930s and 1940s led to these substantial improvements in market effectiveness across many different dimensions. And that's what led to this increase in market effectiveness that underpinned sort of that extremely innovative 1950s and 1960s in the United States. And so it's the improvement in this market effectiveness that led to this period of high TFP growth, not directly in the sense that regulation makes things more productive. It's that regulation shapes the environment within which firms operate. And so, if markets work better, then firms can pursue different, more innovative strategies than when markets work poorly, right? So it's not that regulation directly adds to TFP growth, but regulation creates an environment where firms can do better things, right? So it's sort of an enabling mechanism. And so you have to think about how financial markets affect the way firms behave, and sort of in this big picture way. And it really has, we think, a massive impact. Okay, now, so this idea processing thing I'm talking about may seem kind of abstract and not real, but we think that actually is firmly grounded in the realities of innovation. So there's a lot of related work on this topic, but two papers that I'll mention in particular are this paper by Bhattacharya and Pakalin, who study this kind of quick wins versus innovation strategic choice in the context of science. So scientists have the same problem that firms do in our model. So if you're a scientist starting out on your career, you need to signal that you're a good scientist to get sort of outside support by some party. You need a job from a university, you need a grant from a research institution. Somehow you need some outside party to say you're a good scientist, we're going to support your work. Okay? And so scientists can pursue two strategies to get that support. They can pursue these sort of quick win kind of strategies by doing incremental science that has some immediate payoff, like a publication that's low risk that will get you into the journals and people will know who you are, but it won't be really fantastic work. Or you can pursue a longer horizon, more risky strategy, which actually produces true innovations, but said because you're not producing the intermediate signals, it's harder to get the support you need to actually do this work. And so you have this trade-off. Do you sort of go for the quick win, or do you try to do something great? So Bhattacharya and Pakalin have a way of tracking this choice over time in their various scientific fields, and they find that the Q strategy has come to predominate recently, and that as a result, scientific process has stagnated. And so their explanation for why science is not advancing as fast as it has been in the past is not because there are fewer ideas that scientists can explore, it's because of the strategy scientists use to sort of develop their projects. By pursuing these short-term quick win strategies, they're not really aiming for innovations. And so it's no surprise that they're not finding the innovations that they found in the past. Okay, so we find the same thing in firms. Right? As firms pursue these Q strategies, TFP growth stagnates. So we think that this QI distinction that is sort of the foundation of our theory really reflects kind of a very important strategic choice and a very important aspect of strategy. The second paper I'll talk about here is a paper by Aurora, Bellanzano, and Pataconi, and they examine the composition of R&D spending at US firms. And they find that if you want to create a fundamental innovation, that requires not just an idea from some scientists, you have to put into place the capability to take that idea and access different resources, integrate multiple knowledge streams, and direct research towards solving specific practical problems that actually make something practical out of that idea. It's not just an idea that creates innovation, it's an idea that goes into the firm, and the firm has to actually do a lot with that idea to process it, to actually produce the innovation, fundamental innovation. And that's exactly what we mean by an I strategy. So it's not just ideas, and you can't really think about innovation as just a pure idea. Integration as a whole, innovation is a whole of firm phenomenon. You have to take these ideas and have the entire sort of resources and strategy in place for the firm to be able to exploit that idea and make it true innovation. Okay? And a firm's decision whether or not to do that depends upon how effective financial markets are. Okay. So we think that even though this idea processing is kind of dealt with in our paper in a very abstract way, right, we think that it actually does capture something real and important about the way innovation actually works. Okay, so how do we actually measure market effectiveness then? Okay, so if you compare the impact of these two strategies, a Q strategy produces more signals about a firm's project, and these signals move prices. Right? So Q firms will have a higher standard deviation of their return than will I firms, because they're producing these returns all the time, and so their prices are sort of bouncing up and down a lot. But whereas I firms produce less information, and so their stock price is more stable. So as the proportion of I firms increases, the standard deviation of returns to the market as a whole will fall. Right? So our measure of idea processing capability then is 1 minus the standard deviation of idiosyncratic firm returns, and we control for a bunch of things. So this is just the basic intuition. Now, the crucial thing about this measure that has nothing to do with the TFP data itself. So we define innovation completely independently of the TFP data, and we see if our measure matches the performance of TFP. Can we actually predict the evolution of TFP over time? There's no mechanical relationship between this measure and TFP growth that sort of automatically finds high innovation as we measure it with TFP, right? So that's the so it's actually a real test of the theory. Okay, and so then again, just what we find then is that this measure of innovation, sort of firm of idea processing capability really explains the evolution of US TFP growth over time in a sense that we can predict what's going to happen to TFP growth. So our theory predicts, because innovation is this idea of processing in the pre-war period is essentially the same as it is the post-80 period. We predict that TFP growth in the post-80 period will be about the same as it was in the pre-war period, and that's actually true, right? So this is, I think, the only theory that lets you make these sort of cross-sector or these time series predictions for how TFP growth will actually evolve, instead of just tell a story about what's going on. So we actually make a prediction for what's going to happen here, which is confirmed by the data. Right? So we think that this theory actually captures something really important about how innovation happens. Okay, so if our theory is right, then that means that financial markets play a crucial role in the innovative process by affecting the environment within which firms make their strategic decisions. And so the question is, so if that's true, then how should regulators behave? What should we actually do? What kind of so how can we actually treat the market? How should we respond? Okay, so to promote market effectiveness, which is really important, then we need the following things. We need a regulator with an explicit market effectiveness mandate, so that they actually try to do this, right? Instead of just ignoring it, they have to actually try. This is not something that happens automatically. Regulators have to actively try to maximize market effectiveness. We need a regulatory architecture that enables the regulator to examine the effectiveness of the financial system as a system, rather than as a bunch of separate markets. So financial market effectiveness is a system-wide phenomenon, just like financial stability. And you need to have a system-wide perspective to actually understand what's happening. And then last, we need a regulator with the capabilities required to pursue these topics. So the good news is that India is actually in an excellent position to do all this, as I'll point out in a second. So what do we actually need an effectiveness mandate? Why doesn't market effectiveness just happen automatically? The reason is that we need to think about the financial system as a whole. So if you look at different pieces of the financial markets one at a time, as you do without an effectiveness mandate, then you sort of lose a system-wide perspective. And this is definitely the case that in the UK, where the FCA does not have this vision. For example, think about index funds. I think Emil may talk about this later as well. Index funds are great for each investor one at a time because they're sort of a low cost. They're a great way of accessing a diversified portfolio at very low cost. So investor protection rules then naturally push investors toward index funds, and most market regulators really take investor protection very seriously. Okay? But if you think about it from a system point of view, index funds free ride on the price formation and corporate governance efforts of other investors. So as they expand, they may create negative externalities from the perspective of the financial system as a whole. Right? So if you don't think about how the whole system is working and you think about consumer protection, you may be actually making the financial system perform worse for the perspective of investors as a whole, or certainly for the perspective of the economy as a whole, even though each investor one at a time is actually getting a good deal. Right? So if you don't have the system-wide perspective, you kind of lose this sort of negative externality, which could be extremely important. So basically, for the same reasons we need a financial stability regulator, who has this explicit mandate to regulate the stability of the system as a whole, so too we need a market effectiveness regulator with an explicit mandate to examine the effectiveness of the financial system as a whole from the perspective of the real economy. So to do that, then you need the right regulatory architecture. So you need to have a financial effectiveness regulator who has this sort of who has a financial market expertise, they know what they're doing, and a system-wide perspective. So India already has a system-wide regulatory body, at least our system-wide regulatory institution, the Financial Stability and Development Council, the FSDC, as Dr. Nair was talking about earlier, which brings together SEBI, the Reserve Bank of India, the Ministry of Finance, and other regulators. So the FSDC now has a subcommittee on systemic risk chaired by the governor of the RBI. So what I think what would be useful to have is another subcommittee, a market effectiveness subcommittee, chaired by the chairman of SEBI to promote the effectiveness of the financial system as a whole. So SEBI is the natural agency to take the lead on market effectiveness, given its expertise in financial markets and its work on increasing financial market efficiency. So we'd have the RBI taking the lead on financial stability from a system-wide perspective, and then SEBI taking the lead on market effectiveness from a system-wide perspective. It means we two different subcommittees at the FSDC level to sort of coordinate this effort across the regulatory system. To pull this off, then, SEBI and NISM would actually have to have the right capabilities. So a market effectiveness regulator needs to be sort of research-driven and be, in that sense, more like a central bank. So no amount of data alone will tell you if markets could work better, because always that's kind of a counterfactual statement. You know how they work now, but whether or not they can work better depends on this alternative vision. And you can only find out if markets work better. You need good models and analysis, and you also need lots of data, right? But in addition to the data, you also need sort of, have to do this sort of research on models and analysis to figure out, could you change the rules to make the system work better or not? Okay. To do this research analysis, regulator needs to have some internal research capabilities, the ability to tap into outside research, and the ability to engage with financial market participants from a position of expertise, right? So that, because obviously financial market participants have an enormous amount of knowledge that the regulator needs to draw upon to devise a system that works, right? But you can't just talk to them just randomly. You need to really understand the markets yourselves to sort of get the benefit of talking to the financial market participants, so you know how to interpret what they're saying in a way that you could use to improve the regulatory system. So to develop the necessary skills among the staff, then the regulator will need to engage in in-depth training, because these are all quite complicated, high-level skills. And so you'll need to have a lot of human capital involved in regulation to make sure that this works. So as it happens, SEBI has this educational wing, NISM, which we're all here for. That's ideally positioned to lead on this matters. That says SEBI has created NISM in some sense to sort of advance research and training on financial markets. Right? And so NISM is a great platform that SEBI could use to develop the capabilities it requires to actually pursue this kind of market effectiveness agenda. Okay, so what should be on this agenda, right? So so that is actually, in some sense, that's why we have more than one person talking at this conference, right? So I don't have to tell you exactly what would be on my wish list of things to do. The other presentations at the conference have excellent ideas to inspire us on what kind of things we could do to improve the effectiveness of the regulatory system. And this is just one conference, right? As we were saying as JP and Dr. Dare were saying at the beginning of the conference, we're hoping that this is the first event of the SEBI, SRC NISM partnership, and we plan to do more stuff in the future. And so we'll have plenty of ideas on how to improve the regulatory system, right? But in keeping with the theme of the presentation, we don't really have a shortage of ideas. What we have is a shortage of idea processing capability on the regulatory side, right? And so we have this recipe for increasing total regulatory productivity, but we have the ideas, and we need to build up this processing capability, and then we will be able to just improve the effectiveness of the regulatory system. So I have this vision for instead of improving productivity growth by better financial regulation. Can we actually afford to do this? Well, so everybody knows that we have a low growth problem. It's been in the press in Europe and the US for a decade or more. Most solutions for this problem depart from this endogenous growth theory perspective that we need more ideas, and so they aim at developing policies to increase idea production. For example, spend more money on R&D or some trading or whatever. The nice paper by Bloom et al., where they go through the usual list of the usual suspects of what the conventional wisdom is on this topic. So I don't think this policy approach will actually work, because idea supply isn't the binding constraint on growth. But I could be wrong, right? So we could maybe do both, but increasing idea supply is enormously expensive, as I'll show you in the next slide. So the awful policy mix would be to pursue the enormously expensive and unlikely to work, but somehow extremely popular idea supply option, as well as the incredibly cheap and likely to work financial market effectiveness option. So just to give you some just ballpark numbers on R&D, right? So a major effort to improve financial market effectiveness will cost basically nothing in comparison to increasing R&D by a non-trivial amount. So in the US, the GDP is about 21 trillion per year. R&D to GDP is about 2.8% of GDP. So that's like maybe $600 billion per year. So if you increase that by 25%, to try and get more ideas, that's costing the US $150 billion a year, right? That's a big investment in increasing productivity growth. In India, the GDP is around $2.6 trillion per year. The R&D to GDP ratio is about 0.7%. or maybe $18.2 billion a year. So if you increase the R&D to GDP ratio to 1%, right, from 0.7%, that will cost India about $7.8 billion per year, right? So that's kind of the cost of increasing idea supply in some sense, if you think about it this way, right? Now, that's like I said, $8 billion or $150 billion a year in the US, right? Financial market reform will not cost billions of dollars per year, right? So we're not sure what exactly the budget for the FSLCEC was, but maybe Dr. Nair can tell us, right? But I'm sure it wasn't, $8 billion a year, right? Okay, and so the cost of increasing idea supply is just enormously high, right? And the cost of financial market reform is essentially practically nothing in comparison, right? And so we could do all the stuff that people want to do to increase idea supply, like more R&D, more system trading, all that sort of thing. Okay? And for 0.1% of that budget, we could also have a major effort to improve financial market efficiency, right? Which I think is actually the key binding constraint on productivity growth, right? So any kind of sensible approach to increasing innovation, you would do both these things. You would spend some more money on R&D, but you'd also spend some money on making financial markets work better. Okay. So from a social sort of risk-reward perspective, or from a policy perspective, betting on financial market effectiveness has to offer the best risk-reward trade-off of any policy aimed at improving TFP growth, or really actually any economic policy full stop, because it's hard to think of any policy where you can spend $10 million, right, and boost GDP or boost productivity growth, right? There's no other policy option that comes close to even doing that, right? So it has some enormous beneficial effect for the economy perspective. Okay, so that's basically the idea, right? And I want to leave people that thought that TFP growth really matters, right? This is like the most important economic problem facing us all right now. If we have another decade or two of slow economic growth, that's going to be an economic catastrophe. Without high TFP growth, a high proportion of the population in India and the US and the UK will face extremely bleak economic prospects. India potentially has this really fantastic sort of demographic dividend, right? You have a lot of young workers entering the labor force, which could really power the Indian economy, right? But they're not going to power the Indian economy unless they have actual jobs, productive jobs to go to. And those jobs aren't going to be there if TFP growth does not stay high, right? So unless you have high TFP growth, this demographic boom is going to turn into a demographic nightmare. We have tens of millions of unemployed or underemployed people, right? But effective financial markets could help bring about the dynamic and innovative economy that will transform the lives of India's poor and also help to put India into a position of global economic leadership. Where its fundamentals, in fundamental terms, India should be a global economic leader, right? And so actually get there, we're going to need to have these effective financial markets that will sort of power that transition. Second, we're sadly, our holiday from history is over, and we're now in an era of brutal geopolitical competition where actual hard power matters a lot. So just to take one example, China at the moment is engaged in a massive conventional nuclear buildup, has a lot of troops on India's border, and they're calling the Indian state of Arunachal Pradesh South Tibet, right? And when China calls something South Tibet, right, I would believe them. Right? I mean, they actually have serious territorial ambitions on India, right? And so you need and that's a hard power competition, and India needs to have kind of the skills and resources to sort of resist that kind of coercion, right? A dynamic, growing, and innovative economy creates the resources and skills that you need to support hard power, right? So in geopolitical terms, economic growth is actually really important. But even more importantly, in some sense, is that this competition between autocracies and democracies is playing out on economic and political domains as well as sort of the military domain. And if democracies fail to provide the growth that autocracies do, or at least seem to, then social tensions within countries can threaten political stability itself. And any such social tensions will certainly provide vulnerability that hostile powers could exploit. So economic failure, if we don't actually provide the growth we need to keep the economy going, that's going to lead to not only economic catastrophe, but also social catastrophe. But on the other hand, economic success can play a crucial role to help secure sort of liberty and democracy, right? So if we mess this up, if we really mess up this growth question, we're really facing an extremely bleak and depressing future. So this is actually the most important problem that we could deal. I think that financial regulators actually have an important role to play in addressing this crucial problem for society. So I will stop there. Right. So I said again, this is based on so a paper by myself, Akshay and Dimitri. And if you have said questions or issues that we don't get a chance to talk about now, then obviously email me and we could discuss in offline. So thank you.
Sure. Thank you, Kevin. So, I mean, the paper was so interesting and, so many takeaways for us from India that I'd forgotten the time that we are overrunning the time actually. But yet, there was, it boosted one of the participants to ask a question over there in the Q&A box, which I cannot miss on putting out to you. What he says is that the growing disconnect between the real economy and the financial market is amplified post-financial crisis, versus the 2008 crisis, Mr. Krishnamurthy is indicating, and multiplied, of course, post the COVID pandemic that has happened pretty recently. Do you think the actions of the central governments of, I do not want to say that, but the advanced economies has contributed to this kind of a divide, which is there actually, which is between the haves and have-nots, and maybe to the TFP malaise that you indicated actually?
So I think that central banks so part of the response, part of the reason the divide has happened is because we don't have a vision for how we're going to sort of restore growth to the economy. So we're doing these band-aid type things like quantitative easing or super low interest rates or whatever the central banks are doing, but there isn't as much of a vision for how to restore growth or how to restore productivity growth. And so if you don't have an effective growth strategy, and you have this sort of enormous adverse event, then you're going to do these crazy sort of band-aid type policies aimed at sort of dealing with some immediate problem without having a real solution in place. Okay. So I think that the response, the sort of advanced economy response to even while the financial crisis itself in 2008, and then the sort of COVID as well, has really not been very strategic or not been very effective. Okay? And that we don't really have a coherent plan for how to restore growth. And so I think the policies we have not actually done as much as they could to sort of solve the problems that we're facing. I would say that's true.
Okay, thank you. Pretty much insightful. Any questions, maybe from the panelists or the participants? We can have 2 to 3 more questions. I'm eating perhaps 5 minutes into the break time, but okay. So if there is no question, let me take that liberty of putting that across to you. So you talked about making available right amount of relevant information to the participants actually, and is it not that they're oversupplied in terms of information that they have, and they just run behind stocks in herds because they are aimless, which data to follow and where to go and how to appropriately price the stocks and things like that, and why it is happening. And if I have to so one thing which kept on in my mind is Teslas of the world had driven the development of the EVs, EV sector, but actually it has reduced the the visibility to the other innovators which are coming up in the EV area actually. So what is the next level of information supply? That means clearing the clutter of the information that is available, the financial information about the companies that are available, and providing the participants in the market with the clear-cut information, and providing them with more of education, the do's and don'ts of the market, in terms of using the financial information available and pricing the stocks appropriately. So is that also something which actually could have addressed the TFP problem that you talked about?
So in that sense, so there are a lot of potential things going on. But I don't want to claim at the moment. So I've identified the problem, and I think I have a strategy to try and solve it. But I don't actually have the solutions all in place, right? So I don't want to say that right now I have a vision. Do these 17 things and we're going to fix financial markets, right? So that's definitely so. part of the goal of the talk is not really to say, here are the 17 things we need to do to fix financial markets. It's to say that we have this problem and here's how we can go about solving it, or here's the problem that we should be focusing on. Right. So mostly it's a call. It's not so much that I want to give you the answer for what to do. Is I want to say, this is the problem. These are the problems that we need to think about collectively to try and solve this problem from a regulatory perspective. So mostly my goal is to inspire, you and the participants and other people to actually start thinking about this stuff more, so we can actually get the right answers, right? So that's okay. So to start off, that's what I want to say. So I don't want to say that that if only you guys would give me the pen, I will save the world, right? That's definitely not what I'm trying to say here, right? What I'm trying to say is that this approach will save the world, right? So that's like a slightly less grandiose claim, right? So it's not because we'll take just me, right? It'll take all of you to think about what we should do as well. But on your specific question, okay, so partially is thinking you have to think more about how exactly the market participants interact to create the information that we need. So like one small piece of this puzzle, maybe, or one to illustrate some of the issues, is to think about high frequency trading. Okay. And so you think about high frequency trading, it looks like it produces these sort of benefits because it makes prices more efficient, people respond quicker, news gets into prices faster. That's really good. On the other hand, I think Joseph Stiglitz has been arguing that that's true, but if you're if you're kind of doing fundamental research, right, and you try and think of some idea that this stock price A is undervalued for some reason, and you start buying it, and high frequency traders can see what you're doing, and they start buying it too, okay, and they buy it before you do because they act faster, right? And so they kind of exploit the information that other traders produce, right? And so that creates a disincentive for traders to actually produce that information in the first place. So it looks like prices before we respond quicker to news, which is true, but because the high frequency traders are there, then we actually limit the amount of information that other informed traders create because they can free ride on those, right? And so there's some empirical evidence that that's going on. And so if you think about take a step back and think about the markets as a whole, you say you have these different ways of interacting the markets, so are we actually getting kind of the optimal mix from society's point of view? Right. And it's not obvious that that's the case, right? Or another point on high frequency trading is that that there's kind of an enormous race to see who's first, right? So which is kind of socially just very costly, but not in terms of amount of information you produce for society, not very useful, because if somebody gets there 1 microsecond faster, it's very beneficial for them, but it doesn't really do very much for the efficiency of the markets themselves. Right? And so you have a lot of wasted resources and trying to be slightly faster. Okay? So if you take a step back and think about how is the market actually producing the information that we need, there are a zillion different things you can start thinking about. But we don't really have. We tend to think about them like one little piece at a time. We don't really think about collectively. Is the market system that we have generating the information that we need to sort of price things effectively and efficiently, right? So that's so there are a lot of issues there. I said I don't have the answer, on how to do this yet. But I think that there is the problem that it's a problem we should be thinking about.
Okay. Thanks a lot. So I do have a few more questions, but I think for the paucity of time, I'm just leaving it to a personal interaction, which I would pass on and mail it out to you. Maybe we can take that. Maybe that could be the next level of idea, since you've given us at the NISM a new mandate to measure and indicate the market effectiveness to the market regulator, actually. So we'll be happy to discuss with you and take it to the next level, actually. So thank you to you, Dr. Kevin and Dr. Nair, for an interesting start to the conference, actually, with this interesting session and putting the financial sector issues in an appropriate perspective, actually. So I'm sure the coming sessions, today and tomorrow, is going to be equally interesting, as like the first session, and will be more involving of all the participants, actually. Wishing you both the best, and I conclude this session now here.